At 67, with a big piece of my retirement sitting in SCHD, I found out the hard way that a dividend shield and a price shield are not the same thing. Stick around, because by the end of this video, you'll know exactly what SCHD protects and what it never will. If you're retired or getting close, you want the same thing every income investor wants: dependable cash flow without constant stress. That's exactly why SCHD has become one of the most owned dividend ETFs in the country. A $98 billion fund with a 30-day SEC yield of 3.33% and an expense ratio of just 0.06%. But in 2026, the real question isn't whether SCHD pays a dividend. It's whether that dividend is enough to protect your income when markets drop, inflation stays sticky, and your bills don't take a year off. SCHD Schwab U.S. Dividend Equity ETF. It tracks the Dow Jones U.S. Dividend 100 Index and currently holds 103 stocks, financially strong U.S. companies with a track record of paying and usually raising their dividends. The top 10 holdings right now are Home Depot, Merck, UnitedHealth, Amgen, Abbott Laboratories, Procter & Gamble, Coca-Cola, PepsiCo, Texas Instruments, and Verizon. On screen, top 10 tickers, logos. These aren't speculative names. They're large, cash-generating companies investors associate with stability. That's the whole idea. Retirees don't need excitement. They need consistency. And SCHD is built to be a consistency-first income fund. So if the holdings are this solid, why did my account still take a hit? That's the part most SCHD videos skip. But first, here's why so many retirees fall in love with this fund in the first place. The appeal is simple. SCHD yields more than most broad market index funds while keeping costs almost invisible. At a 0.06% expense ratio on a $100,000 investment, you're paying about $60 a year in fees. On screen, $100,000, $60 year in fees. That means almost all of the fund's return stays with you instead of disappearing into a management company's pocket. It also protects retirees from the biggest trap in income investing, chasing the highest yield you can find. A lot of high-yield products look incredible on paper, and then investors discover the yield wasn't the same thing as durable income. SCHD is built around quality and dividend sustainability, not headline yield. For a lot of seniors, that's exactly what makes it feel like a shield. Worst 3-month stretch, 21.5%. CE is not a bond. It's a stock ETF, so the share price can drop even while the dividend keeps paying. In its worst 3-month stretch on record, the COVID crash of late 2019 into early 2020, SCHD's price fell more than 21%. The dividend never missed a payment. But if you needed to sell shares during that window to cover a bill, a 21% drop doesn't feel like protection. It feels like watching your safety net get smaller, while everyone tells you it's fine. There's also concentration to think about. Even with 103 holdings, the top 10 positions make up about 42% of the entire fund. Healthcare, consumer staples, and energy carry a lot of that weight. So when one of those sectors has a rough year, SCHD feels it more than a fund spread evenly across 500 companies would. If you've made it this far, you already understand SCHD better than most people who buy it just for the yield number. So let's get to the math that actually changes how you should be using this fund. Let's say you need $4,000 a month in retirement income. That's $48,000 a year. At SCHD's current 3.33% yield, you'd need about $1.44 million invested in SCHD alone to generate that from dividends. Pause for emphasis. For most retirees, that's not realistic as a single holding, and it's exactly why treating SCHD as your entire retirement plan is where people get into trouble. It's the same math behind the $100 a day in dividends target you've probably seen, just scaled up to a full retirement budget instead of pocket money. This is where SCHD earns its name back. Used correctly, it works best as one layer of a three-layer income structure. On screen, Layer 1 cash, Layer 2 safer income, SCHD. Layer 1 is short-term cash for near-term spending. 12 to 24 months of expenses you never have to worry about selling stock to cover. Layer 2 is safer income assets, like short-duration bonds or CDs, that cushion the middle of your timeline. Layer 3 is SCHD, or a fund like it, for long-term rising income and growth. That structure means you're never forced to sell SCHD shares in a bad month just to pay a bill. It gives the dividend stream time to do what it's actually designed to do: support your income over years, not weeks. In 2026, SCHD still looks like one of the cleaner dividend ETFs for retirees who want quality, low costs, and durable income. It's actually had a strong run, up nearly 20% year-to-date and almost 29% over the past year. But that strength is the whole point of this video. SCHD looks safest exactly when you're least prepared for it, to remind you it's still a stock. SCHD can absolutely protect your dividend income, but only if you use it as a shield, not a shortcut. Because the moment you treat a stock ETF like a savings account, the market has a way of sending the bill. Not a shortcut. A shield. If this helped you see SCHD more clearly, hit subscribe. I break down one dividend ETF like this every week. And if you want me to run this same math on your own number, drop it in the comments.